89%. That's how much the market dropped after 1929. And right now, Ray Dalio, the man who runs the world's largest hedge fund, is saying we're back at those same bubble levels. Here's what's really going on, and what you should be thinking about right now. Because if Dalio is right, most retail investors are sitting on a ticking time bomb and don't even know it. Ray Dalio, founder of Bridgewater Associates, a firm managing over $150 billion in assets, just issued one of the most serious market warnings in years. His warning isn't vague, it's surgical. He's comparing today's market conditions directly to two moments in history. 1929, when the Dow collapsed 89% over 3 years, and 2000, when the Nasdaq imploded 78% before finally bottoming out. Two different eras, two different catalysts, one identical pattern, and Dalio sees that pattern forming right now. What's driving it? Extreme valuations, concentrated positioning, retail euphoria, and a debt environment that has no historical precedent. The S&P 500's Shiller-Cape ratio, that's the cyclically adjusted price-to-earnings ratio, is currently sitting above 35. The long-term historical average? Around 17. The last time it was this elevated before a catastrophic unwind was 1929 and 1999. Can you guess what happened both times after valuations hit these levels? The market didn't gradually cool off. It collapsed. And here's the number that should stop you cold. The average retail investor today has their highest equity allocation in over 2 decades. You are more exposed right now than almost any point in modern investing history. But here's what nobody is saying about this yet. Dalio isn't just warning about stocks. He's warning about the entire system. His concern isn't a standard correction, a 10%, 15% pullback. He's talking about a structural unwind driven by geopolitical fragmentation, dollar dominance erosion, and a debt spiral that central banks may no longer be able to reverse with rate cuts alone. That changes everything about how you think about a defensive position. Traditional, safe haven, playbooks may not apply the same way this cycle. 3 things every investor should be thinking about right now. Not as financial advice, but as an educational framework. First, audit your equity concentration. If more than 80% of your portfolio is in equities, you're running maximum risk into a potential maximum drawdown environment. Second, look at uncorrelated assets. Gold, short-duration treasuries, and cash equivalents have historically held value during equity dislocations. Dalio himself has been vocal about gold as a reserve asset for years. Third, stress test your portfolio against a 40% drawdown. Not because it's guaranteed, but because if your financial plan breaks at minus 40%, you need to know that before the market tells you. Dalio has been right about major macro turning points before, and wrong before too. But when the man who predicted the 2008 financial crisis compares today's market to 1929 and 2000 simultaneously, that's not noise. That's signal. Here's your verdict question. Dalio's 2 crash comparison is the most important market warning of 2024. Agree or disagree? Drop it in the comments right now. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.